Hey everybody, Ridgely here from Harding Szymanski and Company, and I'm super excited to have with me Sally Campbell, our Vice President of the Tax Department, to discuss a very important topic, which is the 10 common tax filing mistakes that you can make and how to avoid them. So Sally, thanks so much for taking your time to be with us today. I'm excited about this conversation.
Thank you for having me.
Let's kind of jump in and let's have some fun with this, Sally, if we can. So tell us first about incomplete or missing documentation.
Incomplete and missing documentation are a problem. When you are gathering up all the information you need to prepare your tax return, that's the best time to think about how you're going to store all of that information. You need to keep a record of all the positions that you took on a tax return and be able to support them in the event that the IRS should ever question something on your tax return. So keeping those records now will be a favor to yourself in the long run.
Let's talk now about the failure to make a copy of your signed return and all the schedules that go with it.
Making a copy of your return is just a really critical piece in the process of preparing and filing your tax return. Getting a copy, storing it in your electronic files or storing it in your important paperwork is going to do a few things for you. First of all, if the IRS should ever lose your tax return, you have a complete copy of exactly what was filed. Secondly, if you're ever applying for a loan or a home mortgage, you'll have that tax return at the ready to provide to your lender. And third, if you ever want to compare one year to the next, you can have the tax return that was filed for each of subsequent years and compare backwards and see how you're doing.
Makes sense. Now tell us why it is that filing too early can actually be a common mistake.
Ridgely, you're right. It can be a mistake to file too early. We all know that we need to avoid filing late, but if you file too early, you can run a different type of risk. For example, if you're in a big hurry to get your tax returns filed, you get them filed and then a week later, you may receive something in the mail that says, important tax document. This needs to be included in your tax return. So it is important to have the patience to wait for all of your information to come in so that you can file a complete tax return on time.
Got it. Wow. Okay. So how about this? Why is it a common mistake to have inaccurate Social Security numbers or names or even date of birth?
You know, this can happen when people change their name and they think, I have changed my name. I've made this a legal change. I'm using it in all my various locations that ask for my name. Well, if you have not gone into the Social Security Administration and changed your name there, then the IRS is going to reject your tax return under that name that they don't recognize. So for each person who is listed in a tax return, that's the taxpayer, the spouse, any dependents, you need to list the Social Security number and the name exactly as it appears on your current Social Security card.
I can see how that's really important. Now, what about this? What about entering information inaccurately? How is that a mistake?
This is a common mistake. And this can occur when you receive a 1099 or a W-2 and you're hand entering that information and you just make a typo or any other type of an error. The IRS knows what you received and they will recognize that there's a disparity between what they see on the W-2 from their end and what you've listed on your tax return. And you will get a tax notice for these types of mistakes as well.
Nothing that anybody wants, that's for sure.
No.
How about this? Incorrect bank account numbers.
Bank account numbers are listed on the tax return anytime that someone is requesting a direct deposit of a refund. The IRS recommends using the direct deposit method for refund delivery because it is safer and it is faster. So it is a great setup to list your bank account information on the tax return, but it's really important to list that routing number and that account number accurately. Otherwise, the IRS is trying to deposit a refund into your account, and if the bank rejects that, that's going to delay your refund because they'll have to put it in the mail to you, or, God forbid, it goes into somebody else's account. But by and large, they will eventually find you and get you your money, but it is going to create a delay if you are a little sloppy with the input of the account number or of the routing number for your bank.
That would be bad. I totally get it. What about this one that I bet is really one of the more common ones, which is unsigned forms?
Many of us use electronic filing everywhere that we can, but occasionally there is still a form that needs to be paper filed. And in those cases, those tax returns do need a signature in order to be valid. So your filing is going to be rejected. It will not be counted as a valid filing unless the taxpayer, and if there's a spouse, the spouse too, both signatures need to be on that tax return.
Cool. What about the failure to report all income? I know that's a common one. How can that really affect somebody?
You're absolutely right. The failure to report all income can be one of the bigger problems that you can create for yourself. If you had some income from a source that was outside of your regular W-2 employment type scenario, you may receive a 1099 for that income, and maybe you don't. Either way, you need to report that income. The IRS, if there was a 1099 issued for you, then the IRS will be able to match that to your return, and they'll very quickly see that you did not report that income if you failed to report it. And even if no 1099 was ever issued, you do, by leaving that income off of your return, you open yourself up to the possibility that the statute of limitations can just run indefinitely. And that means that the IRS could come back and audit you and collect tax on that unreported income, in addition to penalties and interest down the road. So it is very important to do your best to report all income that you've received.
Wow, I can totally see that. What about this one? The failure to take tax credits and deductions. That's actually somebody that can really hurt the taxpayer.
You're right. That is something that could hurt the taxpayer, because all these tax credits and tax deductions are out there, and they are, if you are eligible to claim any of these benefits, then by all means, you should take advantage of them. This is an area where we do need to be careful. A lot of us talk to family members and friends and maybe read various random articles on the internet describing some great tax scheme that you're missing out on if you don't jump on this right away. And so there are a lot of bad sources of information out there for the existence of certain tax deductions, benefits. So in this area, I would say it's pretty important to talk to your tax professional, figure out if you really do meet all of the requirements for a particular tax benefit. And if you do, then by all means, it's important that you take advantage of them.
Thank you. Now, what about complete charitable contributions? I know this causes some people some challenges.
It does cause some challenges. There are times when you may donate cash, you may donate things that you brought up to the Goodwill. You may even donate your car to a charitable organization. You may donate stock from your securities portfolio to a charity. So all of these various scenarios do come with their own rules about what types of documentation you need to keep and what types of presentations go on the tax return to support that deduction. So this can be a very important area on the tax return for saving taxes and paying the correct amount of tax in the end. So the importance of this is that you do, again, speak to a tax professional, do find out what requirements apply to you to support the deductions that you're claiming.
Great. One final common mistake, and this is kind of a funny one, and I can totally see it happening, claiming a dependent who is claimed by someone else.
This is an area that causes headaches for people every year. It's a situation where one child might be claimed by more than one taxpayer as a dependent. The situation can arise when the parents of one child are not married to each other and they haven't communicated clearly as to which is going to claim that child as a dependent. It also happens, we have seen this where a 19-year-old or a 21-year-old is, say he's a college student and he has a side job and he gets that W-2 and it shows that a few $100s were withheld for federal income tax. So this enterprising young person gets online and files a tax return to claim a refund of those dollars. And that's all great, except for that maybe they forgot to check the box that says you can be claimed as a dependent by someone else. So accidentally, that child has claimed himself as a dependent. Now, weeks later, the parents go to file their tax return. They claim that child as a dependent, and yet their tax return is going to be rejected because someone else, the child, has already claimed that dependent. So there are a lot of different circumstances that can lead to this problem, but I will also say that the IRS has a really clearly defined set of rules as to who really is eligible to claim a dependent. So the keys to avoiding this error are: one, figuring out who really is eligible to claim the dependent, and two, communicating with everybody involved so that there's not an accident where two people claim that same dependent.
Wow, thank you so much, Sally. Incredible information for everyone, worth watching even more than once to make sure that you avoid the 10 common tax filing mistakes. Sally Campbell, VP of our tax department, thank you so much for your time today.
Thank you, Ridgely.